Welcome to our monthly sit-down and discussion of earnings and everything that's going on in the markets. I'm delighted to have in the studio with me Michael Field. He is the European market strategist. So, earnings season, it's mostly done. What's your verdict? You said you were expecting a mixed picture, but has it panned out that way?
I think it's definitely lived up to the billing of a mixed picture anyway. Yeah. We've had some good, some bad and some ugly results on the back of that. And yeah, we can talk about it a bit more, but no, I think we've seen everything. I think investors didn't really know what to expect going into this earnings season. And you've seen that from some of the share price moves, some of the large share price moves, both positives and negative, over the last couple of weeks as investors tried to adjust to all the new information they're being pummeled with.
So apart from our sort of monthly changes to valuations, is there anything that really surprised you from this earnings season that basically has anything affected your worldview, really?
I wouldn't necessarily say my world view. What I would say is that some of the themes that we were seeing previously have kind of become more exacerbated. So I think things like the consumer, for instance, it's clearly become more difficult for consumer-facing firms over the last number of months. You've seen that in some of the retail sales numbers for Europe, but also you're seeing that in the results too from some of these companies that some previously had been doing quite well and holding up quite well in the difficult environment are suddenly saying, okay, now things are even more difficult for us.
That's really interesting because you would have thought that actually now that the times are improving, inflation's falling. So, but you said that kind of consumers have kind of reached the limit in terms of price increases. So that's really interesting. But how does that fit in with the idea that sort of companies like Unilever, Procter & Gamble still have brand power and are still able to charge a premium?
So I think those two things don't contradict each other necessarily, right? So what's happened is you've had 2 years of high inflation. Yeah. These companies have been pushing through price increases, but with difficulty. Yeah. So some things like Procter & Gamble and the likes of Unilever have been achieving pretty good sales growth, kind of high single-digit levels, but that's mainly been price, that the volume portion of that's very low. Yes. So people are in fact buying the same amount as before, if not less, but they're just paying a higher price for it. And these companies do have some brand power to get this through, but not every company has that brand power. Yeah. And you've seen that in this earnings season where some companies who had actually been getting these price increases, their brands are really being tested because now they're saying, okay, we've been putting through price increases for almost 2 years now, and now we've reached the point that consumers are literally buying less stuff, that they just don't have the money and don't have the love of this brand or this product to actually keep paying those price increases. Sure, so it's been really tested is what I would say.
Yeah. I mean, there's a kind of consumer staples element, but there's also, I'm thinking of luxury, and always surprised me, and luxury has been a mixed bag, excuse the pun, in the last earnings season. But companies like LVMH, there was a 20% increase in earnings year on year. Yeah. Big increase in the share price. So they seem to exist in a category of their own. I don't want to single out LVMH, but luxury's always puzzled me. Yeah. Obviously it did well in the pandemic, people saving lots of money and thinking maybe I'm going to spend on shoes or a bag, whatever. But certain companies just seem to exist above the fray, really.
That's fair. But I would say even within that, and this comes back to what I was saying earlier about it being a really mixed picture, even within sectors and subsectors like luxury goods, it's still really mixed. So you've had, if you've had taken a look at Burberry share price over the last number of months, it's collapsed quite heavily. It's very attractive now based on our kind of current fair value estimate for the stock. There's a lot of upside, but operationally they've struggled quite a lot over the last 6-9 months. Yeah. LVMH, as you mentioned, is the kind of counterpoint to that's seeing these huge sales increases, and trying to square that circle is quite difficult. Yeah. The only way in which I can kind of point to some logic around it is that some of these brands are involved in quite niche, maybe growth areas that are suddenly seeing an element of kind of structural uplift and growth, or essentially they've hit a bit of a purple patch. Yeah. And that's kind of what's buoyed the results of LVMH, but hasn't done it for Burberry. Yeah. And then you've got other things, kind of little luxuries, for instance, like Lindt chocolate, which is, doing very well at the moment as well. They've managed to put price increases through, but that's not true to say of every kind of luxury good firm or indeed consumer-facing firm. Some of them are really struggling.
Sure. I mean, that's with Lindt and Easter coming up, that's good news for them, I guess. But so thinking about AI, sorry to change the subject so dramatically, I sort of feel like people have exhausted this subject, and I feel a bit tired of it already. But AI, I mean, if you look at earnings season, anything associated with AI has done well. I'm thinking Meta, Palantir. We've still got Nvidia to come. We've got that whole circus around Nvidia at the end of the month. I mean, reading your summary of earnings season, you said that there are very few attractive entry points into AI. So if, for example, you want to invest today, you want exposure to AI as a theme, how can you do it? Because even companies in Europe with AI exposure are overvalued.
That's fair on the whole, that comment. Yeah, absolutely. I would say, like, any time there gets to be a lot of hype about a certain segment or a certain area of the market, like we have now at AI, valuations just buoy as a result. If you look at like the PE of Nvidia, for instance, it's it's astronomical at the moment, which is always dangerous from an investor perspective, because when you buy a company with a PE that high, the expectations baked in then for growth are huge, right? Because ultimately that has to get back to a normal level of PE at some point in its timeline. So there's a lot of downside risk with these companies. I would say if you look at our fair value estimates for two of the big ones, so ASML and Nvidia currently, they're not astronomical. So despite the fact that on a PE basis they're very high, we think those two companies are around 15-20% overvalued. So it's overvalued. It's not like you should be rushing in necessarily, but it's not crazy overvalued is what we're saying. There is some element of truth to the story that it is very, very high growth. But at the same time, you're paying you're paying a premium for that at the moment.
Yeah, I mean, that is the problem with investing is you see a theme, you see it's hyped, you don't want to overpay, but then you can miss out because Nvidia could have years of growth ahead of it. And certainly I remember last year we adjusted all our models with Nvidia in terms of big ramp up in growth. So yeah, it's a tricky one for investors. So moving on to pharmaceuticals, and GLP-1 is a phrase that I wasn't expecting to say, but Novo Nordisk is another one of those European companies which everyone seems to be excited about. But you think that's now richly valued?
So it's another kind of company that falls under that bracket of, hyped, right? Yeah. So I think the fact that people on the street are familiar with that, acronym you just use for a drug, whereas no one would have known that, 9-12 months ago, is just testament to the level of exposure that these stocks have got, right? And how hyped up it is. I think what we're seeing in the market now, especially in pharmaceuticals, is that the companies that are involved in anything to do with obesity have seen their valuations ramp up hugely over the last 6-9 months. And other companies in other quite attractive areas of, the biotech and things like this as well, oncology, immunology. These companies have seen their valuations kind of dwindle as a result. There's just the interest is shifted over towards the anti-obesity drugs. So I think Novo Nordisk, is there a lot of growth potential ahead for them? Like, absolutely. They're the leader in this drug out and out. But at the same time, we think that stock's overvalued at the moment. And yes, you could chase it, but there's a lot more low-hanging fruit in other areas of pharma.
Sure. I mean, I feel mixed feelings about it because obviously it's a European success story and it's a company that now has sort of global reach, but you want that to be sustained rather than just, obesity drugs are the kind of, the AI of the pharma world. It's everyone rushes in, everything gets overbought. And then, but I mean, you're still a big fan. I remember Pfizer was a huge name during the COVID era, but you think Pfizer's undervalued?
One of the companies, absolutely, yeah. What I would say is some of the companies, and you mentioned COVID, during that period they had this huge ramp up in COVID drug sales, obviously, we all heard about this. But the tail effect is that is coming through now. So you're seeing sales of these drugs tail off massively over the last year or two. And then what that creates is a very high comparison base. So now when they're saying our sales relative to 2022 or 2021, you're seeing these falls, and investors are looking at the top line numbers for these companies like Pfizer and saying this thing isn't growing at all. Whereas in actual fact, what they're missing out on is the fact that these companies do have really good pipelines ahead of them, and that at some point in the next few years, sales from those pipelines are going to overtake the declines that we're seeing from COVID drugs, and then you've got a good ramp up of growth suddenly, and then investors will look and say, okay, suddenly this is interesting again, but they've probably missed the boat at that point from the valuation perspective.
Well, that's a tricky thing for investors, isn't it? Because they don't have the patience to say, well, in the future this will come good and we're at the kind of bottom of the cycle. But like you say, far-sighted investors or institutional investors will maybe say, well, look, we'll just wait until those pipelines kick in, and then. But at the moment, again, you say that's an attractive entry point and a kind of margin of safety to sort of get into Pfizer, maybe Roche as well.
Indeed. I think, look, it's to some degree the picture, you have to look ahead. You can't just look at right now. And sometimes you just have to bite the bullet and say, okay, it's not loved at the moment. It might decline slightly further in the next couple of months. But over the medium term, there's a lot of upside with these stocks.
Sure. So to abrupt shift of tone to shipping. And I know I'm starting to fret about freight rates, the Suez Canal, Cape of Good Hope, sort of thing that I never even thought about before. We've just had Maersk results today, big drop in the share price. Has anything shifted in your, I know you cover shipping stocks, has there anything shifted in the last few weeks?
Not in the last few weeks. I would say the Red Sea situation, and we've talked about this, reasonably extensively for the visibility that we have on the situation. But it's dynamic, right? It's just developing kind of day to day. I think in the beginning, we felt the likelihood of it getting fixed in the short term was high, and now hopes for that have faded.
Yes.
So it seems very much like a medium term situation now, something that could end up lasting well into 2024 or even toward the end of the year, possibly, right? So I think that's still having a disruptive effect on the stock. If you look at the results today, for instance, the numbers were in line with what was expected for 2023. The difference being, okay, they've announced kind of a demerger, which kind of adds another layer of complication to it, but I don't think that's the main cause of the share price fall you mentioned today. I think it's more around, look, they've said for 2024, our guidance range is really wide because we don't know what's happening. Sure. The Houthi Red Sea situation is still ongoing, so they've suspended their share buybacks as well amidst the uncertainty around that. And I think the market has suddenly taken those things as kind of quite a negative, and then they've kind of factored that into the share price today. But this isn't the first time for Maersk, right? No. For the whole of 2023, they were downgrading profits consistently, their guidance for 2023 profits. And I think this year they're just trying to kind of come in with a clean slate and say, look, we don't know what's going to happen. This is kind of a wide range of expectations we have, and the market's taking all that negativity into one day.
Yeah, I mean, I think that's sensible from a company point of view, but it seems a bit irrational from an investor point of view. But like you say, the shares have had a really good run up so far this year. Best performing share in Europe so far in January.
Could well be. It had a nice run, albeit off a low base, is what I would say.
Yeah. So an adjustment to expectations is kind of normal in markets, isn't it? Indeed. But you were saying, in terms of reading your report, in terms of trends in shipping, as rather like the oil tanker that takes a long time to move, trends change slowly. There isn't just a sudden shift in dynamics.
No, that's a very good analogy, given that the last Suez Canal incident was indeed an oil tanker that tried to turn very slowly.
And we've had another one since that's got stuck.
Indeed.
But it seems daft that the world depends on a very, very small shipping canal, but that's...
And another one in Central America that is having its own issues with climate change and stuff. So I think those two things, as kind of, as amusing as we're making them sound, are indeed... kind of testament to how fragile the shipping network it is, which is something we've realised during the pandemic, and now we're seeing again with these Red Sea attacks,
Yeah. But I mean, I guess people might just have to wait longer for their goods, perhaps. I mean, it could be the world adjusts to not instant logistics, and
that's certainly what's going to be felt now with certain goods, right? I think also what you saw since the pandemic is that whole concept of nearshoring. So European retailers and industrial firms bringing some manufacturing back to Southern Europe or North Africa or Turkey, and US firms bringing manufacturing closer to the border, Mexico, for example, too, to kind of counteract those issues that you mentioned.
Yeah, I mean, I guess the world adjusts to new problems, doesn't it? I mean, I realised we're running out of time a bit, so I was thinking about the next time we meet, what will be going on? We've got UK budget, we got Fed at the end of March, and we've got Bank of England as well. So earnings season may be over, kind of nearly over, but there's still a lot to go on in the next few weeks.
Yeah, indeed. So I think yes, earnings season. We've got a few companies, some of the big ones too, left to report. So I think there still could be a few kind of left field surprises to come through.
Yeah.
That's one thing. And then I think from there, the picture moves on to the macro, like you said, right?
Yeah.
To some degree, the Fed minutes and the Fed decision is less relevant to Europe than it was maybe a year or two ago.
Yeah.
That I think the paths have diverged.
Yeah.
The economic situation's weaker in the UK and in Europe than it is in the US.
Yeah.
So central banks in Europe have a slightly different problem to adjust to, and they could well cut rates before the Fed. So I think that's the kind of decisions to keep an eye out for. Are we expecting anything immediate in March? I think that might be a little hasty.
Yes.
But it's definitely worth watching and analysing the changing language to see if that's softening up for the next Fed or for the next Bank of England or the next ECB meeting, rather.
Yeah. I mean, there's certainly a lot going to go on in the macro this year, and the first rate cut will feel like a significant moment. Whichever central bank's going to be first probably won't be the ECB. So...
You will see. We'll see. You never know. But I think, it's like you said, right? It's the direction of travel is the main thing rather than the quantum of the rate cut.
Yeah. Brilliant. Anyway, so join us again soon in the studio if you can, but I might see you virtually next time. But thanks for your time today. And for Morningstar, I'm James Gard.